So TiE is a very high-minded organization, and its core value is that the most successful people in the society have an obligation to help the next generation of entrepreneurs because it's the entrepreneurs who solve the most pressing problems of the society. So it's a very high-minded organization, and people who believed in that core value, they joined TiE to, to give back in a variety of ways to the next generation of entrepreneurs. So for instance, when I was running it, there were 400 invited members. 100 of them were C-level CEOs type or C-level people, like CEO of Adobe, CEO of Micron, CEO of Informatica, CEO of Zscaler, CEO of Palo Alto Networks, those kind of people. And then there were another 100 who were, senior VPs and other in large corporations. But the most dynamic group was 200 very successful entrepreneurs who had sold their company for more than $100 million. This is founders of Hotmail. These are founders of Brocade. They're founder of Poshmark. They're founder of, including Zscaler, and on and on and on and on. I mean, so it was a very, very exclusive group of people, and they all came together with the core conviction that if an entrepreneur needs help, they will find time. So I had an understanding with all these members that if I send you some entrepreneur, you will give that person 30 minutes of your time. You may not give it this week or next week, but within 4 to 6 weeks, you will find time to give 30 minutes to this, including the biggest guys in the network. And that's a very powerful thing. I mean, I don't know if you know the story, the story about how Steve Jobs, as a 19-year-old, wrote to Andy Grove, who was the CEO of the biggest semiconductor company in the world, and says, "Hey, I'm starting a computer company. Can I get you some time?" And he actually got time from Andy Grove. So this culture of paying it forward, I think that's what was the core on which TiE was founded.
Yeah, I think of Vish Mitra, with being willing to have not just 30 minutes, but like 2-hour brainstorming whiteboard sessions with me. And the guy was just stopping and smelling the flowers. I mean, he enjoys what he's doing. When he's helping someone, it is clear that he's just oozing happiness. And this is why we're here. We're in Palo Alto. We're in Santa Clara. We're figuring something out and investing in each other, with joy and happiness. That's really the vibe of TiE. It's amazing. I think the I stands for Indus, like, India, but it's very Silicon Valley open door mentality, welcoming me and others into it. So I think it's fantastic. Hello, and welcome to Fireside with a VC. Today, I'm delighted to be with Venktesh Shukla, or Venk as he's known throughout Silicon Valley and the world. Venk is the founder and head of Monta Vista Capital, an early stage venture capital firm in Silicon Valley. He also has an illustrious career as an operator, as a founder, CEO of multiple startups. Has probably seen all forms of startup combat, from the good, the bad, and the ugly, and the difficult, and maybe is able to bring some of that experience to his portfolio companies. Venk was also the president of TiE, which is the premier. I'm not Indian, but I sure feel like I'm a part of it. If I have 100 things to do on any day and one of them is go to a TiE event, that's what I'm going to do. And I've just made some really good friends, and I've always had just the best time. It's entrepreneurs helping each other, the most amazing vibe. And so Venk was actually the president of the Silicon Valley version and the chair of the global version. So true honor to be with you, Venk. Good to see you.
Good to see you too. Uh, Good to see you. I mean, I think you touched upon a number of things. I think one way, one way I've been different from all the other Indians that you have known is that I'm an accidental immigrant to this country. Uh,
Accidental.
I have no desire to come to US. Uh, I was fat, dumb, and happy as part of a very powerful Indian bureaucracy.
It was like
And
the IRS, right? Didn't you start your career on like
yes,
the Indian version of the Internal Revenue Service?
yes. So civil service in India is very, very powerful. And when I graduated from college, it was even more powerful. The free market and liberalization is has cut down the power dramatically, but at that time it was pretty powerful and very satisfying. So I was part of that, and then I got married, and I got married, you see, with the expectation that my wife, who had finished her undergraduate in engineering from Berkeley, would move to India, and she had very different plans, and it came as a surprise to me. So I resisted that for a couple of years, but eventually, uh, as a compromise, I came here to do my master's at MIT, thinking that that's my, this is my gesture of goodwill on my side, and then that will convince her, to go with me to India. But instead, I stayed on, so she won.
Well, I met your wife. I met your wife a couple of weeks ago at the Legacy Builder event in San Jose. So walk us through quickly. Give us a speed tour about what you did before Monta Vista. So talk us through some of the entrepreneurial events. It looked like a Silicon Valley story to me.
Yeah. So I worked in two big public companies before. One was Teradyne, and second one was Cadence Design System. And Cadence Design System, entered, as a marketing manager, and within 2.5 years, got three promotions and became a vice president. And it turns out that I think I was the first Indian uh, to have risen to a VP position in a Fortune 500 company based on sales and marketing background rather than tech background. All the Indians you see before that had tech background.
Okay.
So I grew from sales and marketing organizations. But what I realized was that one thing that I enjoyed the most was spending time on product issues and with customers. And one day I actually analyzed my calendar for last 3 months and came to this conclusion that 70% of my time is either preparing for a meeting, participating in a meeting, or following up from a meeting. And another 15 to 20% of my time is on HR issues, hiring, firing, one-on-ones, performance reviews, and stuff. The thing that I enjoyed the most, which is the product issues and talking to the customers, was less than 10% because that involved travel also. And
Hmm.
I said, I don't want to do this. So I quit and joined this startup. And luckily for me, the very first startup I joined it did incredibly well.
And
It
you
gave me
became CEO of that startup, didn't you?
No, I was the first adult supervision. I was not the CEO,
Okay.
but I had a pretty decent position in that company, and gave me financial security. And most of all, it was very exciting because unlike in a big company, there was a direct correlation between the decisions you made and the impact you saw immediately. And that was intoxicating to me. So after that, I never went back to a big company.
Yeah. I've actually never worked at a big company. It's kind of a missing thing in my career. Normal people have never heard of any of the startups I've been part of. So I don't even know what it's like. Uh, you know, other than a little acquisition integration and move on. And so tell us about raising venture capital in the Valley. How long ago did that start for you on the
You know,
entrepreneurial
well,
side?
So I was in a number of startups. Some of them, did well. Uh, and some of them, what Silicon Valley calls a valuable learning experience.
Right. Expensive,
And
valuable.
and my last startup was that. It was a valuable learning experience. My learning was don't jump into anything until you have done your diligence. So, uh, so I told my wife that I won't, for 18 months, I won't jump into any other startup. I would just take my time and look around and stuff. Then I got bored very quickly. So I started, one thing I'd always wanted to do was do a better job of angel investing. The first round of angel investing, it was a disaster.
Right.
I invested in 22 companies by that time, and
Over how long a period of time? Because that's better
about
than
10
most.
years. About 10 years.
10 years. You see, that's the thing, the key to investing is diversification. And most angels fail to achieve that, in my opinion. And if they do achieve some diversification, it's not within a economic cycle. You know what I mean? It's
Yes.
like
Yeah.
if you want to be an internet investor, get going in 1993 when Mosaic came out, and maybe what'd you do from 1993 to 1995, and then what you do from 1995 to 1997, and then and then of course the internet, or the dot-com crash. 10-year cycle 22 is better than most, but it's still a little dangerous compared to maybe what you do at Monta Vista now.
Yeah. No, I think this thing was very lopsided in the sense that all my investments were concentrated between 1997 and 2001. And that was the worst time to invest.
Or
Uh,
it could have been the best time. I mean, if you were, depending on what the exits were.
yeah.
But it
So
sounds
it
tough.
turns,
I was looking at your LinkedIn a minute ago and saw like you really you sailed straight through the storm. Like I think I saw you were 1999 to 2001 somewhere.
yeah. So what happened was that I made investments in 22 startups. Uh, 20 of them went belly up. Luckily for me, two of them, paid for my sins. And but it always bothered me. It bothered me that I had such a high rate of failure. So I analyzed why I made each one of those investments. It turns out that I invested because I owed somebody a favor,
I
whatever.
call that guilt, the guilt
Yes.
investment.
Yeah,
It's
they
a
say,
guilt
hey,
investment.
Venk is here, blah, blah, blah. You should please invest in this because what. So I said, okay, fine. That was one. The second one was because, uh, you know, because I didn't know anything about the domain. But the founder and this thing sounded very persuasive and made it very compelling. I had no idea about this thing. I said, what the heck? Let me do that. And so those were the two reasons. And the third one was that third one was just the herd mentality that a lot of people I knew were investing in something. And I said, if this guy
Uh,
is so
Kind of
smart.
party round,
Yes.
social proof. Yeah, it's
Yeah.
not good. It's not good.
So, so then when I analyzed, I realized that all these three are really, really bad reasons to invest.
Yes.
So I said, okay, what would be a good reason to invest and how would I do that? So I analyzed that and I came up with my framework. So then what I did was I started this angel investor group within TiE. It surprised me that TiE, for all their talk about fostering entrepreneurship, they didn't have a mechanism to invest as a
And
group
Venk,
in
could you,
startups.
for our listeners that are unfamiliar, there's people from everywhere. What is TiE?
So TiE is a very high-minded organization, and its core value is that the most successful people in the society have an obligation to help the next generation of entrepreneurs because it's the entrepreneurs who solve the most pressing problems of the society. So it's a very high-minded organization. And people who believed in that core value, they joined TiE to, to give back in a variety of ways to the next generation of entrepreneurs. So, for instance, when I was running it, there were 400 invited members. 100 of them were C-level CEOs type or C-level people, like CEO of Adobe, CEO of Micron, CEO of Informatica, CEO of Zscaler, CEO of Palo Alto Networks, those kind of people. And then there were another 100 who were, senior VPs and other in large corporations. But the most dynamic group was 200 very successful entrepreneurs who had sold their company for more than $100 million. This is founders of Hotmail. These are founders of Brocade. The founder of Poshmark. They're founder of, including Zscaler, and on and on and on and on. I mean, so it was a very, very exclusive group of people, and they all came together with the core conviction that if an entrepreneur needs help, they will find time. So I had an understanding with all these members that if I send you some entrepreneur, you will give that person 30 minutes of your time. You may not give it this week or next week, but within 4 to 6 weeks, you will find time to give 30 minutes to this, including the biggest guys you see, in the network. And that's a very powerful thing. I mean, I don't know if
Oh,
you
yeah.
know the story, if you know the story about how Steve Jobs, as a 19-year-old, wrote to Andy Grove, who was the CEO of the biggest semiconductor company in the world, and says, "Hey, I'm starting a computer company. Can I get you some time?" And he actually got time from Andy Grove. So this culture of paying it forward,
Yeah.
I think that's what was the core on which TiE was founded.
Yeah, I think of Vish Mitra, with being willing to have not just 30 minutes, but like 2-hour brainstorming whiteboard sessions with me. And the guy was just stopping and smelling the flowers. I mean, he enjoys what he's doing. When he's
Enjoy.
helping someone, it is
Yeah,
clear that he's just oozing happiness. And this is why we're here. We're in Palo Alto, we're in Santa Clara, we're figuring something out and investing in each other, with joy and happiness. That's really the vibe of TiE. It's amazing. I think the
yeah,
I stands for Indus, like, India, but it's very Silicon Valley open door mentality, welcoming me and others into it. So I think it's fantastic. And so, and what is the chair of the global? What was the work involved for you, or what was your involvement there?
so what happened was that this TiE in Silicon Valley was very, very successful, and it became sort of a phenomenon in Silicon Valley. And so people who were in other parts of the world, they wanted to replicate that model. So we set up this separate organization called TiE Global, which essentially, licensed the brand and the practice and the values to other centers of entrepreneurial energy, like Boston, like Delhi, Atlanta, and Singapore and Hong Kong and on and on, and London. So essentially, we license that brand and you see the practices to a bigger group of so that these kind of things could be, at the ground level. It's a bottom-up kind of an organization. So each chapter is fairly autonomous and independent, and it is given that kind of autonomy to maximize its impact you see on the local community.
Mm-hmm.
So now we have about more than 50 chapters in 17 countries in the world, and
Fantastic.
it has that cachet. So much so that when the Prime Minister of India, he wanted to, he came to Silicon Valley, we had a long conversation with him and with his. I was the host. I hosted him for a couple of days in Silicon Valley,
Wow.
and we had a long conversation. There was one meeting where we were doing a digital India dinner where we invited 200 C-level executives of Silicon Valley to this dinner. And on the stage were CEO of Adobe, CEO of Cisco, CEO of Qualcomm, CEO of Microsoft, CEO of Google, the Prime Minister, and me. I was the host of this thing.
Amazing.
And before we came for that big public meeting, we had a conversation in Prime Minister's suite in the hotel. And some CEO was asking about some policy in India. And Prime Minister says, whether you are a small company or a big company, whether you are a domestic company or a foreign company, whether you are in this industry or that industry, our policy is the same for everyone. So I interjected. I said, excuse me, sir, if you treat a 3-month-old baby the same as a 30-year-old man, guess who's going to suffer? So to his credit, he didn't take offense. He turned to one of his bureaucrats traveling with him, and he looked at him and said to him in Hindi, he said, "You are going to spend time with him tomorrow." And as a result of that, 3 months later, the Prime Minister launched with great fanfare this program called Startup India. And that was in 2016. And today, India has become the third largest entrepreneurial ecosystem in the world. And it all
Sure.
started, you see, from that, the 2016 announcement, about 4 months after, you see, I started working with them.
That's quite quick. That's quite fast. So let's talk about Monta Vista Capital. We made the first investment from our Fund One in March of 2014. So I think it was around a similar time that you guys started,
Yes.
maybe 10 years ago. So
Yeah.
10 years ago, that's when you started. I believe you're investing out of Fund Three now.
Yes. Yes.
Very close to us. We're investing out of Fund Four. We've got a drop of capital in Fund Three. Fund Three is almost fully deployed. What is the investment thesis now on what you're looking for?
The investment thesis has not changed. We focus exclusively on B2B. We focus exclusively on three areas. One is that something which just Silicon Valley is very good at, which is technology infrastructure for cloud, cybersecurity, and data. So any infrastructure play is typically horizontal play across these things we like. The other things we like is vertical SaaS, focusing on a particular industry like automotive or retail, something like that. And the third one we like, and I think that's where we are pretty different from other VCs in the Valley, is we like digital transformation of old industries like shipping, mining, textile, construction. And we like those because, so for instance, there are a lot of companies, there are a lot of expertise in Silicon Valley on self-driving of vehicles. There's no one who understands mining.
Yeah, yeah,
There are a lot
yeah.
of
I
people in the
agree.
world.
These big industries, just a small bit of introduction of technology, automation, leveraging data, unlocking that it is paying huge dividends. What the startup can charge to that customer is far less than the reward the customer is getting.
It's just mind-boggling. I think
Yeah,
we
yeah,
invested in a company called Safe AI, and I told him he left Apple in disgust. He was in the self-driving business unit there. They were not doing anything. He got frustrated. He left, and he wanted to start a self-driving company. And I said, "I'll give you $1 million tomorrow if you promise not to get into passenger cars or commercial trucks. If you focus on industrial vehicles only, I'll give you $1 million."
right.
So get $1 million. He made that pledge to me. And today, that company is on the verge of delivering, working mining trucks, where the customer is willing to pay the company 200,000 per vehicle per year. They
And what
have
does it cost to make it?
each mining truck costs about $5 million. And in order to run it 24 hours, you need 4 operators. You're paying those 4 operators to send them to jungles of Congo. You're not going to get them in Congo. So you're going to get them from Australia, Brazil, Chile, or Europe or US. That one truck is $800,000 to $1 million a year. And it's unreliable because humans, if they get bitten by a snake, they become alcoholic, they run away, whatever. This machine works all the time. So they're willing to pay this tiny little startup $200,000 per vehicle per year, and they have 100 vehicles. So the very first customer will give this company $20 million a year.
Wow.
And there's no competition because the manufacturers of these trucks, which is really two, Caterpillar and Komatsu, they would rather sell a brand new self-driving mining truck for $5 million than retrofit an old truck that they have sold for $200,000. So there's no competition.
Interesting. So what stage are you investing at? It sounds like that is pre-seed of pre-seed, you know.
Yeah. We do, about 75% of the companies we invest in are pre-revenue.
Okay.
We call them pre-seed or seed, but they are pre-revenue. And
Pre-revenue.
yeah, and most, that's the most difficult stage to make an informed decision. And we take pride in the fact that we make fewer mistakes than others do. The industry standard I have seen, industry benchmark I have seen is that pre-revenue investment in pre-revenue startups, 60% of them fail. Our failure rate across the three funds is about 20%.
20% failure. I once heard Hans Swindlin from Industry Ventures say, if I see a VC with a failure rate below 30%, I won't invest. I want to see them taking enough of a risk that there's a 30% failure rate. At the time, I thought, we're not taking enough risk because our failure rate is more like 19, 20%. And you know what, Venk? Give it time. Give it a few more years, and you will find your 20% failure rate maybe was 30, or God help me, even worse. Um,
Yeah,
so it was
yeah,
funny. First of all, I was surprised to hear him say that. And he's a big fund-to-fund investor, and he's got a lot of direct strategy too. But I took his word to heart, and I thought I needed to be taking bigger risks. Not really so. Just give it some time. It takes a bit of time for all of this to play out, in reality. So when you see failures at the pre-revenue investing stage, how long does it take to get to a definitive shutdown?
the companies that fail, they fail pretty quickly, and
Okay.
within first 2-3 years they fail.
Yeah. What kind of cash runway do these companies have when you're funding them?
Typically, they have 12 to 18 months.
12 to 18 months?
Yeah,
Yeah,
12 to
I guess
18 months.
they don't want to raise too much money when the stock is theoretically cheap, and that kind of leads to these short runways. I like, we used to say we like an 18-month runway, and if we don't see an 18-month runway, we don't want to wire. And we're not your bridge financing company. When times get tough and the market gets rougher, I kind of like to push that to 24-month runway.
Yeah,
The
yeah,
problem with that is that if you really want to be early, if you want to be pre-revenue, which we're not right now, it's tough to get an 18-month runway. Or sorry, it's tough to get a 24-month runway when
it
you're,
is.
when they're just trying to test the thesis and see if this Bunsen burner science experiment works.
Yeah, no, you're right. I think it's very hard to uh, to get uh, to get that thing in 12 to 18 months, because if it's really pre-revenue, they have not even built the product. It takes a while to build the product, and it takes a while, you see, to go to the customers. It takes a while for the customers to try it out and then give them the feedback and stuff. And the worst thing that could happen is the first two customers pay them money, and that gives them a false sense, you see, of of, product market fit. And
Yeah, yeah.
it takes a lot, a lot longer, you see, for the reality see to come through, that the first two customers you see where, these are the enthusiasts, these are the early adopters, these are the guys they see who would try anything new, but it's not indicative of the rest of the market.
Yeah, we're living through a strange period in history right now where I think a lot of Fortune 500 companies are under pressure to do something about digital transformation, to do something about artificial intelligence. And so they're willing to even buy buy some software to show their boss that they're doing their job. And it may not necessarily be a proper indication of product market fit or the value exchange of what they're paying for the software is less than what they're gaining, from adopting it. Um, so it's like it takes a little more investigation to measure uh, this is working and that this is
Yeah,
going to scale.
yeah. No, I think this is very interesting. This thing that you brought up in the first two funds, there was not a single insider round that we had to do. All of them were either shut down very quickly, or they were able to raise funding.
From
So
a new
in
investor, from a new investor joining.
yeah. So in the first two funds, we did not have to do a single insider round. In the third fund,
Wow,
in the
that's
third
amazing.
in the third fund, we have already done six insider round.
I was going to say, yeah. Insider rounds for those listening that don't know what that means is, a company raises money from one or more investors, and then when it's time to raise the next round, it's the same investors that pony up more cash. So it's called an insider round. In a perfect world, a new investor joins the syndicate, perhaps leads the syndicate, and puts money in at a new higher valuation. And that higher valuation is now validated that this new share price, this pre-money valuation, this post-money valuation is validated by a new person parted with cash to purchase that, as opposed to, you and I fund a company and then you and I fund a company again and again and again at higher valuations. And, the startup was willing to issue a stock at that new valuation, but it's not validated by someone new. Um, the I think that in 2021, companies raised money at a very high valuations, and then the market corrected or adjusted, and a lot of these companies wanted to raise more money. No one was willing to invest as the new investor, and there have been a lot of insider rounds only. Often even the company doubled revenue and is raising money at the last pre-money valuation. That's quite common, right?
Yeah,
We've seen a lot
yeah,
of that. So, you know, it just shows this company raised at a high valuation, market adjusted, companies doubled, tripled revenue, and they're raising another round, inside round, last valuation. Quite
yeah,
common into this
yeah.
2024. We're still pushing through. We're still pushing through the 2021 thing.
Yeah. No, you're absolutely right. I think uh, we are seeing that, you see, which is very interesting. I mean, in the first two funds, not a single company needed our money, uh, and they all raised the next round of funding. Either they failed or they raised next round of funding.
Right.
And here you see more and more, and these are good companies. These are really, really good companies. They have customers, they have products, they have revenue, and yet they're not meeting the threshold for Series A investment that the VCs is here demanding now.
Yeah. I mean, across four funds, we've got nearly 100 portfolio companies at this point. And some of them are good companies with great customers, growing revenues, great teams, doing amazing things, but they're not AI enough to capture the imagination of a lot of the kind of herd mentality of investors. And so we've seen some companies have a tough time raising money that even a year ago or 2 years ago um, would not have struggled so much. And I think that I'm personally witnessing investor appetite being just more and more and more concentrated around where is the AI magic that you're working on. They're like, well, we're solving a problem. The world's broken. We're fixing it. And this is what we're doing. And they're like, making it harder, in my view.
The interesting thing is that it's hard to see a pitch that does not claim to have
Doesn't.
AI in it.
Yeah, yeah. I always say that it's like the LPs slap some labels of buzzwords on them. It's like the NASCAR driver with all these logos of his sponsors. They slap a few buzzwords on themselves. Then the VCs are like, oh, that's what you want? I'm gonna slap that buzzword on my pitch deck for raising LP capital for my VC fund. And then the startups go, oh, that's the buzzword that you all want to fund. They slap those buzzwords all over themselves and then do it.
Yeah,
There's
yeah.
AI and there's artificial intelligence. Like, is it really? I mean, if this, then that in an Excel spreadsheet, does that mean it's AI? But why don't we talk about AI? So who do you as an investor, when you see that something is a layer on top of OpenAI, or even that theoretically soft computers can write the software, like software can write software, what you're building is maybe not so unique. Um, how do you feel, or even what's your evolution been over the last kind of 18 months on how
You
you
know,
think about how to
you
not
know,
invest in something and watch it go depreciate to zero in 5 minutes?
it's interesting. We invested in Gen AI companies before ChatGPT came and became part of pop culture.
Yeah, we were in Kindy and Pryan years before opening. Sam Altman left. YC.
Yeah. So we invested in a company called Convey, Convai, in October, and in February of that November, is a ChatGPT came, and in February, Jensen Huang had his keynote, which was watched by 2.5 million people, and he demoed this Convey stuff as part of his keynote to convey what kind of capabilities his processor enables that was impossible just 6 months ago. So Convey got flooded, you see, with customers and all of those kind of things. And then there was this frenzy around generative AI. And I'm very proud to say that we looked at about 100 of those companies. And we have, by the way, we have very, very deep bench of machine learning, reinforcement learning, and Gen AI experts, you see, in our fund. A really, really deep bench that even the biggest funds probably don't have access to that kind of experts. Uh, so we looked at a lot of them. And as you said earlier, a lot of them were just a thin layer on top of ChatGPT.
Yeah.
And others where they were just we will apply rack to this and this and stuff. There was not We didn't find, you see, very significant differentiation. So I was surprised to say that in 2013 we did not make a single Gen AI investment, not one. But
I mean,
in
Gen AI is just a part of AI, though, right? I mean, that's a relatively small subsector, really.
Yes, yes. But all the frenzy was around Gen AI. It was not around regular AI. And we just, I think what we found, what we have discovered is that when the hype cycle kicks in, the valuations as you go berserk. And so you invest either before the hype kicks in or after it is deflated. But in the hype cycle, is only those people invest, only those VCs invest who want to impress, you see, their LPs by getting the next round of funding at a higher valuation.
Right. That's my statement is not a joke about, the LPs get the labels, then the VCs get the labels, and then the startups get the labels, and then it all ends badly.
So we don't do that. I mean, we really, we don't raise funds, you see, on a clock. If it takes 4 years, it takes 4 years. If it takes longer, it will take longer. But we will invest only with the conviction not based on the next sucker theory, but based on the fact that we have a very, very high degree of conviction that this will continue to generate higher and higher revenues you see as time go by. So that means that hype or no hype, you look at the companies from a very, very different lens.
Yeah. Well, I like the way you're using the word revenue. That at the end of the day, you're focusing on companies that are going to do something for a customer where there is revenue.
Yeah,
And
yeah,
that's the key, as
yeah.
opposed to a party round where looking back at your 22 investments and the 20 mistakes, that just because Eric Schmidt is in the deal and Joe Lonsdale, I'm feeling excited. I was just at a dinner with everybody. It's intoxicating. I'm investing. That's bad.
Yeah.
You got to stay sober and not become intoxicated by that, social proof. And you got to go back to first principles and think about what you're doing in a world where budgets are getting even more AI focused. They can't get rid of cyber. They got to keep that budget. Are they really going to make budget for this? These other guys can afford to lose money. I think you and I can't. I
Yeah,
mean, they
exactly.
can afford to just be like, easy come, easy go. I'm Eric Schmidt. Here's $5 million. Here's $1
Yeah,
million.
yeah.
And whereas $1 million is a meaningful percentage of our fund. We got to look after that and not just drive home from a dinner in Palo Alto and just wire money that evening without
The
without
other
getting into it.
the other thing that we have come to realize is that more crowded a space it is, more difficult it is for a small venture fund to make money on a particular deal, because crowded means that that the sales cycles get longer, there's more noise, and it means that there'll be many more rounds of funding before a winner eventually emerges, winner or two eventually emerges. That means, you see, you have to have the capacity to keep investing, to keep your ownership. And small funds just don't have, at least we don't have. So we stay away. We know that this space will produce a big winner, but out of this 30 companies, which one is very hard to tell.
Yeah, yeah. Howard Hartenbaum from August Capital calls this venture fracticide, where too many companies doing the same exact thing get funded, and the press, like TechCrunch, doesn't even know what to say about yet another crowdfunding website. I mean, you squint your eyes, they all look the same. They're fighting over the same customers. The customers are confused of which one to go with. It's hard to recruit talent, and they lower their prices, and there's commoditization, and it's bad.
Yeah, yeah. So
So if too crowded is bad. I think that if you go back to what you were saying earlier about digitization and vertical SaaS, for every idiosyncratic industry, that if you bring a bit of digitization to the big digger, Caterpillar, Komatsu industry, they're like, hey, someone showed up with a little bit of technology in my big old dirty industry. That makes sense. So,
yeah,
and you were talking about a company had no competition.
yes.
I tell founders, don't say I have no competition, because that's probably not true, but uh, staying away from an industry that's overly crowded, and you're
Yeah,
fighting. I mean, you end up giving $100 bill to get $2 back from your customer if it
yeah,
gets too crowded, and that's
yeah,
problematic. That's
yeah.
problematic. How many, Venk? How many companies did you find was the right number of companies per fund? Now that you're
We
managing other people's money and your own,
yeah.
what's the right portfolio construction that you've evolved to, or has that stayed the same across vintages?
So, one thing that we quickly learned from the first fund is that I did an analysis of the first fund, and I realized I invested in the first fund in 22 companies. And I did a quick calculation that if I had stopped investing after 10 and I put the rest of the money in these 10 companies, I would have done far, far better. Because if good entrepreneurs are coming to you and you're making good judgment, why won't you maximize your ownership, you see, of those deals
Yeah.
rather than spreading yourself thin? So second fund onwards, in second fund, we have only 12 major investments
12.
in the
Okay, wow.
in
That's concentrated.
very concentrated
I
in
mean, I
the
think below 15 is dangerous. And I'm a little paranoid about even that, ship starts sinking to the bottom of the ocean. What am I going to do if this doesn't work career wise?
yeah.
So we kind of say 25, but as the portfolio evolves, we can maybe focus on 18. But we're shooting for 25. And I think of our funds as somewhat similar.
Yeah.
So it's good for us to even, talk this stuff through. So you realized you would have been better off had you concentrated in the initial 12, and that diversification was maybe almost playing it too safe. And there's detriments to this. Um, what are you thinking now?
Same thing. I think we have so one thing that we started to do is we started to invest, you see, in incubation rounds, very small amounts in a company where we are not sure, but looks high potential. Say, what the heck? I'll give you up to 500K and watch, you see how you do. And
What kind
then,
of ownership are you getting? I mean, what evaluations look like for incubation? And if it's incubation, does that mean it was your idea and you
no,
recruited
no,
the
no.
team?
Incubation means, you see, somebody else's idea. We are giving them small amounts of money and watching their small amounts of money at a very small valuation.
Right.
And
How small?
well, so in one company, we invested 500K at 8 million valuation.
Okay.
Uh, they had already raised money, say, before at that from angel money. So we give them another 500K and say, okay, go, let's see how much progress you make. They did. So we give them another 500K, this time at 15 million post. And, if they come through again, you see, we'll put another $1 million into the company. So we have started doing those kind of experiments, but in terms of major investments, it's still 10 to 12 per fund because we do with very, very high conviction. And the failure rate in those ones is extremely low.
Yeah. And also, if you're, I mean, knowing you as I know you, and my God, your network of people that like you, I'm one of many. If you're concentrated on 10 or 12, that means you're focusing your time on those. It's like I once met a guy in Riyadh who told me he had 25 wives and 100 children. And this guy was like taller than anybody you've ever met from the NBA. This guy was huge. And I thought to myself, how good a father can you be to 100 kids? you know, but if you've got 10, 12 portfolio companies and they've got your attention, you're going to have a good reputation. When you ask those CEOs, what do they think about you? They're going to be like, oh yeah, we meet every week. Whenever I'm in my car, I get them on the phone. There's a little bit more time and attention to be in that concentrated strategy. Of course, the other thing is that when one of them hits, it's not weighted down by 249 other investments, right? There will be impact from
Yes,
it. Your
yes,
If you drill for oil 12 times around Bahrain, you might get oil or you might not. If you drill
yeah,
for oil 25 times, around Bahrain, your statistical mathematical probability of striking oil goes up, you know, but it's weighted down by the losses.
yeah, yeah, yeah. Uh, Yeah, hey, Andrew, this has been great. I really, really enjoyed having this conversation. And we should really, really collaborate to see on deals. And maybe we should have session where I take you through my portfolio, you take me through your portfolio, and see if there is a way that we can collaborate and co-invest.
That's exactly what I think I said to you when we first met, and we should absolutely do that. It would be an honor, and I'd love to do that. In closing out on this conversation, Venk, where do you see the exit? I mean, like there seems to be we're kind of in a dangerous point in history with exits. At the same time, we all know that there are exits. I think that a lot of the people in the podcast sphere seem to be talking that there are no exits, but exits don't need to be decacorn in size, right? Especially if you're getting in at an $8 million valuation. But what's your perspective on that on the exit market right now? And is it just M&A and IPO, or do you guys see secondaries as a path to liquidity for your LPs?
Yeah, no, I think we have done 2 deals on the secondary market, and we are open to doing more. I think because because our LPs, you see, do want liquidity, and if M&A is not happening, and if going public is not happening, but there is a secondary market for those investments, we are very open to that. Primarily, see, from the standpoint of returning liquidity to LPs. So we already done 2 of those deals, and we're looking at 2 more.
Yeah, yeah. I mean, when you're investing as early as you are, or as early as we are, and we leverage our networks and get them funded by much bigger funds that have a problem of how do I move $3.2 billion every 2 or 3 years? The size of those checks is driving huge valuations. In the 90s, these would have been considered fantastic exits. And these are just pre-money valuations now. So we're doing that ourselves. That's kind of part of our playbook is invest, double down, SPV, start selling.
Yeah. Yeah.
I mean, if you can get them on that path, and then our DPI is better than anybody's in a world of no DPI
Yeah.
distribution to paid in.
Yeah.
Be the league table leader in it. There's got to be
Yeah.
some reward for having invested early, not the longest time horizon to exit.
Yeah.
That's my view. Well, fantastic. Well, listen, great to see you. I'll be in Silicon Valley, I think the week after next. I'll coordinate that trip with you and hope to see you in person, and
Great.
maybe we grab dinner with you and your wife. I love the story of she forced you to stay in the United States. I married a woman from Bratislava, Slovakia, and she was like, I don't know why everybody wants to move to the US. She had no interest in moving to the US. I could hardly get her to come. And then what I did was I kept her in London for 10 years and then took her to Silicon Valley, and the sun was out, and she's like, maybe I can handle the weather. California's not so bad. So I pulled it off in the end, got her to come to the States.
Great. Congratulations.
Yeah. Okay. All right, my friend. Thanks so much, and talk to you very soon.
Hey, thanks, for really honored to be on your podcast.
Thank you. And by the way, introduce me to who's running TiE in Austin. I've moved to Austin, Texas, and I'd love to dive into that community as much as possible.
Let me find out who that is, and I'll connect you.
Okay, wonderful. We can maybe even do a TiE event right at my house.
Okay. All right. Why not?
Okay, Venk. Okay, bye for now.
Bye.